I'm going to speak to you today not just about the news headlines, but about the structural shift happening beneath them. We are witnessing the fracturing of the global economic order. With the ongoing war in Ukraine entering its fifth year, the recent and dramatic open conflict between Israel, the US, and Iran, the rules of the game have changed. This isn't just about geopolitics. It's about your wallet, your savings, and your job. Today we're looking at the three undeniable economic phenomena we can expect from this new reality. The first and most immediate phenomenon is the return of persistent structural inflation. We aren't talking about the post-pandemic supply chain blip. This is different. Look at the Middle East. The recent escalation directly threatens the Strait of Hormuz, through which about 20% of the world's oil trade passes. Historical data from the International Monetary Fund shows that a sustained 10% increase in oil prices can add roughly 0.4 percentage points to global inflation. And we aren't just talking about gas prices. Oil is the lifeblood of everything: transportation, plastics, fertilizers. Combine this with the ongoing fragmentation caused by the Ukraine war. Since 2022, we've seen the disruption of 28% of global wheat exports and 40% of potash fertilizer exports. When energy and food costs rise simultaneously, it creates a cost-push inflation that is sticky and difficult to cure. Central banks like the US Federal Reserve now face a nightmare. They were hoping to cut interest rates to stimulate growth, but with inflation flaring up again, the US PCE price index recently hit a 2-year high. They may be forced to hold rates high or even hike again. The era of free money is well and truly over. The second phenomenon is the permanent fragmentation of the global economy. We are moving away from a single global market to competing geopolitical blocks. The sanctions on Russia were supposed to be a swift knockout punch. Instead, they've proven that the global economy is now multipolar. Russia pivoted its energy exports to China and India, mitigating the impact. This tells us something crucial. Sanctions no longer work the way they used to in a unipolar world. Now, we're seeing the rise of what experts call war economies. Russia is currently spending about 38% of its federal budget on defense, which props up its heavy industry but creates massive labor shortages and overheating at home. For the rest of the world, this fragmentation means supply chains are being rewritten for security, not efficiency. Trade routes are being rerouted, and costs are rising. The International Monetary Fund has warned that this fragmentation is a massive setback for global cooperation and prosperity. For businesses, it means you can no longer rely on predictable global supply. You have to build resilience, which is expensive. The third phenomenon is the extreme polarization of financial markets. We are seeing a classic risk-off environment, but with a modern twist. In times of war and uncertainty, capital flees to safety. We saw gold surge past $5,200 an ounce recently, a record high. The US dollar is strengthening as global investors park their money in what they still perceive as the safest asset in the world: US Treasury bonds. But here's the dangerous part for the average person. While safe havens boom, risk assets, like stocks in emerging markets, or even cryptocurrencies, can get crushed. We saw nearly $50 billion wiped off the crypto market in minutes following the recent Middle East strikes. For developing nations, this is a brutal double whammy. Stronger dollar makes their foreign debt more expensive to pay back, while rising energy prices blow up their import bills. We could be looking at a debt crisis in vulnerable economies, which would then ripple back to the banks in developed nations. So what does this mean for you? We have to stop waiting for a return to normal. The normal is gone. We are likely looking at a world of higher for longer inflation, volatile markets where political news moves the needle more than earnings reports, and a global growth slowdown. The key to surviving 2026 isn't chasing high returns. It's building resilience. That means diversifying your investments, paying attention to geopolitical risk, and preparing for a bumpier ride. Thank you for watching. If you found this analysis helpful, please subscribe for more expert insights on the global economy.